Okay, let's dive right into this explainer and unpack exactly how Bank of America just delivered an absolute blockbuster second quarter in 2026. If you've been following the financial sector at all lately, you know that balancing everyday consumer banking with high-stakes institutional trading, well, it's no easy feat. But the data we're looking at today reveals a totally fascinating story. We're seeing a bank hitting its stride on almost every single front. So we're going to look at the raw numbers, their massive digital transformation, and the broader macroeconomic signals hidden right there in their balance sheet.
CEO Brian Moynihan really sets the tone for us right out of the gate. I mean, when a bank of this sheer size declares it delivered one of its strongest quarters to date, you'd kind of have to pay attention, right? He highlights a massive 34% year-over-year jump in earnings per share. This wasn't just a good quarter, it was a historic one. It proved that their strategy of really deepening client relationships across the board is actually working.
So to make sense of a massive corporate earnings report like this, we're going to break it down into 5 quick steps. First, the headline numbers. Second, Main Street and wealth. Third, Wall Street surges. Fourth, credit health and capital. And finally, number 5, the bottom line.
All right, kicking things off with Section 1, the headline numbers, a record-breaking quarter.
The bank pulled in a staggering $9.1 billion in net income for the quarter. To put that into perspective for a second, that is roughly $100 million in profit generated every single day for 90 days straight. That's wild. Against the backdrop of a really shifting economy, Bank of America managed to bump their total revenue to over $31 billion, driven by higher net interest income, asset management fees, and a huge surge in trading.
And that massive profit translates beautifully to $1.21 in diluted earnings per share. Now, this is the number Wall Street analysts and everyday shareholders literally obsess over. Jumping from 90 cents up to $1.21, that marks a 34% leap from the exact same time last year. It tells us the bank isn't just growing its top-line revenue. They're incredibly effective at turning that revenue into actual, tangible value for their investors.
Visually, the momentum here is just undeniable. We're looking at a 27% year-over-year jump in total net income, climbing from $7.2 billion up to that $9.1 billion mark. This clearly illustrates an engine firing on all cylinders. And this growth wasn't just isolated to one lucky division. As we'll see, every single business segment reported double-digit net income growth.
Moving right along to Section 2, Main Street and wealth, the digital evolution.
The major takeaway here is that Bank of America is honestly functioning a lot more like a massive tech platform than a traditional legacy bank. They now boast 50 million active digital banking users. But even more surprising, their AI virtual assistant Erica has nearly 25 million active users and handled millions of interactions. When 70% of your total sales are digitally enabled, you are fundamentally changing the DNA and the cost structure of your business.
Let's just compare their physical footprint against that digital engagement. They operate 3,530 traditional brick-and-mortar financial centers, right? That's a huge footprint. But contrast that physical space with 4.4 billion digital logins in just a single quarter, along with an 80% digital adoption rate among households. It becomes incredibly obvious why consumer net income hit $3.3 billion. Their operational efficiency just skyrockets when customers can do pretty much everything right from their smartphones.
And this digital push, it directly coincides with real, on-the-ground economic activity. The consumer banking data shows a 9% increase in combined credit and debit card spend, totaling $266 billion. So consumers are highly active, and the bank is capturing that activity super efficiently. Plus, they maintain their spot as the absolute #1 U.S. consumer deposit bank.
Meanwhile, let's pivot and see how this momentum builds into their global wealth and investment management division. This side of the house brought in $1.4 billion in net income, and they are managing a mind-blowing $4.9 trillion in client balances. That's a 12% jump, fueled mostly by higher market valuations and solid asset flows. It shows that as the stock market rose, their wealth managers successfully captured and grew their clients' assets.
Okay, on to Section 3, Wall Street surges, investment banking and trading.
So, while the consumer side was humming along digitally, investment banking fees absolutely exploded. They surged 50% year-over-year to $2.1 billion. This tells us there's a major thaw happening in capital markets right now. After a pretty quiet period, companies are finally returning to Bank of America for major debt underwriting, equity underwriting, and advisory services. Deal-making is officially roaring back to life.
And over in global markets, it was an exceptional quarter. Sales and trading revenue hit $7.1 billion. But what really stands out in this data is how perfectly balanced it is. You've got $3.6 billion coming from equities, which actually surged an incredible 70% due to strong trading in derivatives and cash. And then you have $3.5 billion from fixed income, currencies, and commodities. It's essentially a perfectly balanced dual-threat trading desk.
This incredible top-line revenue growth drove $2.6 billion straight to the bottom line in net income for this segment alone. And the best part? They managed this while maintaining an average value at risk of just $49 million, meaning they generated these massive returns without taking on wild, outsized risks on the trading floor.
Now, with all these record revenues, the billions of digital logins, and those explosive trading fees, we have to pause. We need to ask the critical risk question that ultimately determines the true health of any bank. Are people actually paying their money back?
To answer that, let's quickly define a banking term: provision for credit losses. Think of this as a rainy day fund. It's an estimation of potential losses, essentially money the bank sets aside right now to cover loans they think might go bad in the future. When a bank raises this number, they're worried about the economy. But when they lower it, it means they are highly confident in their borrower's ability to repay.
Which brings us to Section 4, Credit Health and Capital, the strong foundation.
The data tells a very comforting story here for sure. Not only did Bank of America's provision for credit losses drop from $1.6 billion a year ago down to $1.4 billion, but their consumer credit card delinquencies are actually getting better. Both early and late-stage credit card delinquencies improved for the 5th consecutive quarter. So against a healthy economic backdrop, resilient consumers are out there managing their debt really well.
Because of this robust credit health and their massive influx of revenue, the bank had excess capital. And what did they do with it? They returned an incredible $8 billion directly to shareholders in a single quarter. They paid out $2 billion in common stock dividends and spent $6 billion repurchasing their own stock, which of course helps drive up that earnings per share number we talked about earlier.
All right, let's pull this all together with Section 5, the bottom line: efficiency and looking forward.
The ultimate goal of bank management really comes down to efficiency. As CFO Alistair Borthwick highlighted, disciplined expense management combined with strong revenue growth drove their efficiency ratio down to 59%. In banking, a lower efficiency ratio is better. It means it costs you less to generate every dollar of revenue. They improved this ratio by roughly 360 basis points from a year ago, basically proving they are making substantially more money while keeping a very strict lid on their operational costs.
And this leaves us with a fascinating final thought to ponder. We are seeing an incredibly powerful dual-engine growth story here. You have Main Street consumers adopting AI and digital banking at totally unprecedented rates, while simultaneously, Wall Street deal-making and trading are roaring back to life. If Bank of America can maintain this 59% efficiency while both sides of the economy are accelerating, how is this going to reshape the broader financial landscape as we move into the second half of the year? It's a question absolutely anyone invested in the markets should be asking right now. Thanks so much for joining me on this explainer, and definitely keep your eyes on those digital adoption numbers.